Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. We're going to quickly review the market from last week, take a look at what's going on this week, and then we'll open it up a little bit after about 20-25 minutes to some questions about individual stocks or questions you might have about the market. Then we're going to go on talk a little bit more about the CTI and how to protect your portfolio on market downturns as the CTI goes to a negative, to a sell this Friday. And we'll talk about some different strategies that you can use to maybe make a little bit of money off the call. Okay, last week we saw the Dow Jones break its 5-week win streak. Every index was down. Russell 2000 was the weakest link. It was down about 2%. The momentum, Market Edge Momentum Index fell to a +1. Sentiment Index went back to neutral at +1. And we saw a lot of the bearish sentiment that's been around for most of the year starting to slip away. CTI went to neutral last week because of the position of the short-term, the A cycle. I left it at neutral rather than going to a sell then. And we're projected to go to a -2 this Friday. Cycles A, C, and E will be bearish, and while B and D are bullish. Profit taking was pretty much across the board last week. Only the healthcare sector and technology sectors were higher. The sectors that we've seen lead the market over the last 4 or 5 weeks, especially energy and materials, happen to be two of the biggest losers. So that's something to take note of. Part of that was strength in the U.S. dollar after some of the Fed regional presidents came out and kind of went against what Yellen said at the March FOMC meeting. They started talking about possibly a rate hike was on board for April. I didn't check today, but the CME Group FedWatch had it somewhere around 12 or 15% for an April hike. I don't think that's on the table, but I think we'll probably start rattling the sabers about for a June hike. Okay, also saw some deterioration last week in the internal breadth indicators. NYSE and NASDAQ advanced decline lines were both lower, and we also saw contraction in the number of new 52-week highs versus new lows. That was a little bit bothersome, and we're starting to see some negative divergence showing up in the charts, especially on the Dow Jones Transports and the Russell 2000. 14-day RSI is showing pretty blatant negative divergence, along with MACD ST, which is our short-term, I guess 1226.9 is also signaling for most of the averages now a short-term decline. Okay, last thing I want to mention, over the last 2 weeks, we've had 2 weeks of accommodative central banks boosting stocks. We had the Bank in Japan and in the Eurozone actually cut rates further in negative territory. And we're getting back to the point where the central banks aren't going to have much ammo to correct the slowdown, which is just going to be part of the natural business cycle. Economic data this week is actually very heavy. Actually, yesterday on Monday, we had the first quarter GDP was cut from 0.9%. They cut it now. We're looking at 0.5% for the first quarter. And also earnings for the first quarter, when they were projected to be down about 3% on January 1st, they're now slated to be down anywhere, according to FactSet Research and S&P Cap IQ, somewhere close to 8%. That'll probably come up towards the end, but we're still probably looking at about a 5 to 6% decline in first quarter earnings. All right, what we're going to look at today, we're going to look at some of the support areas of the different indexes, where we can target a pullback on the Dow and some of the other indexes, and how we can potentially profit from the weakness. Okay, I want to pull up the major indexes first, but before I do that, I showed this chart last week because a lot of analysts will talk about the fourth year of a presidential cycle being positive for stocks. However, they don't mention the 8th year of the presidential cycle, which isn't quite so good. So we're right about here right now, and which is funny because the CTI is actually flipping over to a sell, which is going to stay a sell till about the end of May, which would take us over to here. We actually go to a buy in the CTI for much of the summer, then we flip it again over here. And sometime over in here is where the cycle E, the long-term cycle, will probably bottom, where we can probably flip it over to another bull market at that point. So just to keep this in mind, this is 5 of the last 6 presidential terms, and on average, the S&P and 500 have been down more than 10% on those years. All right, so what do we look at here? Here's the Dow Jones. First, let's look at the Fibonacci retracement level. We have a 50% move off of this move from the move back in November to the February low. It's going to take us down here right about 16.6, 16.7. That also coincides with pretty much where the 50-day moving average. You'll also see kind of a descending trend line going back to the highs in May, where we came up and bounced off of that. We're going back, and the Dow Jones ran out of gas right where you would expect it to. That's that descending trend line going back from last May. So that's where we stopped. We had the 200-day moving average right over here around 17.1, 130, something like that. We'll probably go down and test that. If we break that, I would imagine, at least for temporarily now, we'll see a target down here around 16.7 or so for the Dow. Okay, for the S&P 500, looking at the same thing. Here's a long-term trend line going up there. We didn't even make it to that. But we crossed over the 200. Now we're coming down to test that 200 today. S&P's down, but we're at 2035. Let's see. That's 23. We're right about here still. Around 2020 is the 200-day moving average. The 50% retracement level on this would be somewhere around the 1960. That also is just above the 50-day moving average, which is around 1945. So that would be a normalized target where we could probably see some breaking up. In fact, if you see this breakdown around 2005, 2000, I think you'll see a pretty good move down here to that 1950 area pretty quickly. Okay, the NASDAQ doesn't look quite as good. We've actually failed to hold this 100-day moving average over here around 4,800. We've come back up. We're just shy of it again today. We're up 18 points, right around 47.85. The 50-day moving average is down here around 45.75, and the 50% retracement off of this move from here to here is coming in right here at about 46.80. So the target would probably be right around this area in here, maybe 46.50, 4700 for the NASDAQ. Okay, the Russell 2000, we talked about, number one, the negative divergence down here in the 14-day RSI. You can see over here at, mid-March, towards the end of March, the RSI got up here around 80 as we made another new high. Didn't even come close at all to that coming up here. And we also have the MACD, the 12.26.9, giving a sell signal on that over here too. So the fact that we failed failed at the 100-day moving average, didn't even get close to the 200-day moving average on that. You'd like to see the small caps lead in a growth environment, so that's another red flag. But the 1075 is where the Russell's battling right now. That's also the 50% retracement level going back here to the November high. So right around, we're at 1086 right now. We break below 1080, 1075. We're probably going to go down and test even lower down here around the 61.8% retracement level around the 50-day. That's 1025, I believe. Yeah, right around 1025. Okay, the next chart we're going to look at real quickly is the transports. We were all excited about this move in here. It was a heck of a move. It kind of outperformed on the way going up. And what was nice about that was because the transports led on the way down. But we're having negative divergence over here on the RSI where we didn't quite make the peak, where we made back here in mid-March. Made another big high in here on less strength. We also have another negative divergence here in the MACD, which is a red flag. We break below this 200-day moving average, which is where we are right now, right around 7,800. That will open it up to the 50% retracement. You want to see if we can find support on the transports down around 7,400. The 100-day is right around 75 and change. So we'll keep an eye on that area. This is probably where I would think we'll find the first level of support. Okay, another way that we can look to see where some targets might be would be just to measure the move from January, February lows up to the highs that we just made. So if we could come off here and get a 50% retracement off the Dow, we're still looking for a pullback down here for this would be around 16.6, 16.7. That's very close to the 50-day moving average. The 200-day moving average is up here at 17,128. That's also where the 38.2% retracement is also. You can also see, well, never mind, it's shown on this chart. Okay, on the S&P 500, using this as an extent of a move, if we roll over on that, we come back down here to the 200-day moving average, which also matches up pretty closely to the 38.2% retracement. That's taken out. The 50% retracement would open the door down here to about between 1945 to 1960, where the 50-day comes in. That would be our short-term target on this pullback for that. The NASDAQ it didn't quite do as well as the other moving averages. We stumbled right here at the 100-day moving average. Couldn't quite get through that. And now we've kind of rolled over a little bit. 47.86. We're still battling that 100-day moving average with today's move. If the 50-day moving average is down here around 45.75, and the 50% retracement is around 46.70, 46.80. So this would be our kind of short-term target on the NASDAQ. Looking at the 200, let's see, that also failed at the moving average. Looking for a piece of line here. Okay, anyway, what I want to talk about right now is what we can look at if we go to when we flip to this negative call, negative sell on the market this coming Friday. Now, there's a lot of different ways you can take advantage of the CTI. Number one, if you're going to be real conservative, perhaps you maybe just come off margin if you're on margin. Another way would not give yourself much exposure would be maybe to sell some covered calls on some of your positions. Another way would be to buy puts on big positions on stocks that have had a nice move off the February bottoms. Maybe some of these material stocks and energy stocks that have, maybe in some cases they've even doubled. You might lock in some profits by buying some protection. The other way would be to buy short or leveraged ETFs. Now, if you want to know how this can protect you, let's look at the put strategy first. And this just for an example, we'll say you have a $1 million portfolio. Okay, our downside targets on the CTI, if we figure about a 10% correction or pullback on this move going out into May, let's say, for example, in this case, although most people have more volatility than the regular S&P 500, but if you have some fixed income in there, let's just imagine for this example, you get about a one-to-one move with the S&P 500. So you decide that maybe I'll risk 5% of my portfolio to protect myself to the downside on a pullback. That would be about $50,000 that you would actually end up putting into put options, which may sound a lot. It seems like that's way too much money to expose to options. Another thing that you can do is you can sell covered calls to bring in some of the premium to cut down the risk on some of your positions. But anyway, if you take that $50,000 to buy puts, what you would do is you would buy some at-the-money SPY options. Currently, the S&P 500 is around 2035. If you look at the May 20 SPY 2030 puts, they're trading right now at about 445, which would actually could give you about comes to about 44.50 on each contract. You can buy 10 or 11 contracts. That'll take up your 50,000, and then they'll expire on the May 20th. If you get a quick move, of course, you want to sell them. But that around May 20th is when the CTI is scheduled to bottom. So if the market would go down, let's say 8 to 10% on this move, without the hedge, your portfolio would go from $1 million down to about $950. buying these put options, you can probably at least break even on some of these positions. Again, if you want to, if you don't feel comfortable putting that money in options, by selling some covered calls on some of your other positions, it'll help cover up the some of the money that you're putting out. Okay, the main way that I play on this with the CTI is through leveraged ETFs. And you can go double leverage, triple leverage. What I've been doing is doing triple leverage. And so far for 2016, here are the exact trades that we've made coming into the year. We were short going into the year as we went short last November. But we bought SDOW, which is the symbol for the short leveraged Dow, SPXS. We bought it at $16.92 on January 4th. Here's the NASDAQ SQQQ. We bought that at $18.65. You can check these prices on Yahoo if you want. And then we also buy the Russell 2000. The reason I buy 4 indexes is because you're not sure exactly which ones are going to outperform or underperform the others. In this case, if you had bought just the S&P, when we closed it out on January 29th, you'd have made 13%. Okay, well, when we closed out the Dow, we made 19.3% during the month of January. The NASDAQ, we made 19.46%. And you can see here the Russell 2000 underperformed. We made 26.19% on that call to the downside. Okay, just for the sake of marking these things, when we close the position, we immediately go long when the CTI goes to a buy. So we open up the long positions on January 29th. The symbols for the leveraged triple ETFs we bought here, the U Dow was at 53.76. The S&P was SPXL at 69.89. The NASDAQ was at 84.58. That's TQQQ. And then the long Russell 2000 is URTY at 55.41. We closed out these positions this last Friday on the Dow. Okay, we had 53.7. We made 21% on the Dow, just over 15% on the S&P, 14.92 on the NASDAQ, and 11.46 on the Russell 2000. Okay, so that using those, so far for the year on trading these ETFs, going short, going long, and getting ready to go short again. Right now we're up 35.29% versus being up 0.52% for the Dow. And those are the actual trades. And what we'll do is we're going to go, we'll buy the short leveraged CTIs, ETFs on this Friday. Now you can see that you're going to get different results, because you don't know which ones are going to lead and which ones are going to lag. But these ETFs are leveraged 3 to 1. So if you're wrong, there's going to be a little bit more pain than if you went to just a straight up 1-to-1 ETF without the leverage. But so you're going to have a little bit more slippage because you're not always going to be exactly right. And generally, these calls are right about 75% of the time. Okay, problems with doing this, you're going to have they track closely to the index, but not all the way because there is some little bit more slippage. They rebalance these nightly, which also causes a little bit of slippage. And but these things also are meant to be short term, and by short term I mean they're intended to hold these for the amount of a run, which generally is only going to be about maybe 1 or 2 months. So you're not buying these things just to hold on to for an extended period of time. Okay, this is a comparison chart that you can see where when you have the big moves, they get exaggerated. Now this over here, this is where we had that flash crash where all the ETFs went down like 50%. Hopefully they've corrected that. But here's our move coming down here at the beginning of the year. We had a big nice move up in the leveraged ETF, kind of bounced around here, and we came down. As this thing's rallied, we've had a great move to the downside on that. So that'll show you that you do get exaggerated moves. But I might even suggest that if you're a little nervous about doing this, you start out with small positions that make up a certain percentage of your portfolio, and you can even paper trade them just to see how you would feel if you had $20,000 in on these things, and all of a sudden you were down $10,000 after 2 or 3 weeks. But this will show you how much the extent of these leveraged things go. So just to wrap it up real quick, trying to keep it in this 20, 25-minute things. We're going to open it to questions. So if you have something, go start typing them in now. Okay, when you're buying the puts, you want to keep an eye on the VIX. This is if you don't do the leveraged things, because the higher that VIX goes, that means the higher the price you're going to pay for your protection. Normally, I would think if you can get the VIX under 16 or 17, you're paying a reasonable price for some hedging your portfolio using the puts. The VIX gets up in the high 20s, and then you're thinking about buying protection. You've probably already missed it. The traders are already a little bit worried there, and they're looking for the market to go down. So at this point, with the VIX around 1489, this might be a time where you could add, where it might pay to buy some puts if you don't like the leveraged ETFs. So again, if you buy the puts, you can always sell some covered calls on some positions that from some of your individual stocks, and that'll offset the cost of buying some of the put options. So I'm going to wrap it up like that. If you go back and play this later on, you'll be able to see the symbols for these leveraged ETFs that we use. Again, I would recommend buying a couple of them just to spread out your risk a little bit. And what we'll do is we'll buy these things at the close on Friday. You could wait till Monday, just whatever you get. But just for the way we have to keep our records, we always do it at the closing price on the Friday when we're going to make the flip. Okay, I see a couple questions in here right now, so we'll open this up and take. All right, what happens to current longs? Okay, we closed the longs, went to cash. So we're in 100% cash on the CTI long short portfolio right now. Again, we'll go into these four the short leveraged ETFs on Friday at the close. If you want to wait till Monday and just buy the open on Monday, you can do that also. Anybody have any other questions on these or on individual stocks that you're looking at right now? Okay, we have Janet Yellen while somebody's just typing, I think now. We have Janet Yellen talking this afternoon. We might get a little bit more of a little more clue on what the Fed's looking at with these rates. We had you have too many guys coming in talking off the cuff with the Federal Reserve right now. She comes out with a very dovish statement, and then a week later you have all these guys coming in saying we're putting April on the table. So you want to watch that. That's kind of keeping the market going back and forth in here. Still waiting for somebody they were typing. Okay. Can you talk more about the slippage in the leveraged ETFs? Why does that happen? The slippage on the ETFs, on the leveraged ETFs, one of the things that they do, it's not a lot of slippage, but rather than tracking the different indexes point for point, they have to close out these futures and the contracts that they hold in these positions each night, so they rebalance the portfolio. The slippage on that can be 0.5% or 0.75%. It's not a lot, so you're more concerned with slippage in the actual by being leveraged. The market goes 3% against you. You're talking about looking at maybe being down 10% on slippage on your actual investment. Okay, should we close current long opinions? I closed mine on Friday. I would the market's up today. I would now if you're talking about current long positions on individual stocks, no, I don't do that. I will leverage if you're flipping in and out of everything. You're going to have a lot of fees. If you've got some of these materials energy stocks that have doubled and tripled, I would buy puts on those because you don't know if oil goes back down to $30. They're going to get clobbered again. So I would I would lock in my profits with a put on that. But if you're talking about going to leveraged ETFs, I would close them out by this Friday and then get ready to go long the short ETFs. Okay, what percent of your portfolio would you suggest for these CTI trades? That's hard to say. I would to try something out like that. I think you want to see how they trade and how comfortable you are. Where if we go in here at where we go short here and the market goes up another 5%, are you comfortable with, say, if you have, say, if you're 20% of your portfolio is tracking the CTI trades? Are you comfortable where that say $20,000 goes down to, you're down like 35, 40%? That might get a little bit hairy, and you may not feel comfortable with that. So I would start out with maybe 10% or something like that, where you feel comfortable, and then as you the trades begin to build up, then you can take some money off the table, or just roll the amount of the say they start out with $10,000, and you've done a couple of trades, and you're now at $16,000. Okay, maybe now instead of putting $2,500 in each ETF, you're putting $4,000 or $5,000 in each TF, or you could take some money off the table that way also. So, and also that would also prevent one position getting too big. Okay, I don't see any more questions coming in right at this point. We're right about that 30-minute level. Again, okay, somebody else has another question. Again, if you have some questions that you would like to look at going forward, you can always send it to the doc at marketedge.com, and I will take a look at it. Okay, we had a question on MMM. Let me go over here. Oops. Okay, MMM, let's see. Okay, no, it's had a heck of a run off of the off of this. A lot of this is as the dollar came down, you had quite a run in these the industrial companies. As long as the dollar stays low, this should be fine. That opened the door for for the industrials to not lose so much on the currency risk going forward. The RSI looks good. MACD short term is kind of going sideways to flat, but you've already recovered more than the whole move down from this. That's a 1 year. That's good. Your risk on this is you've had a heck of a move, but also your risk on this is if the dollar strengthens, if they keep talking about the raising rates, that might cause some of the industrials to go. But it looks fine. You had a nice cross again here with the 50 over the 200 day. It's had a heck of a move. That's all. I will say that, but it looks strong in here, as a lot of the industrials do, as the dollar's backed off. If I do a comparison with this, so as you see the dollar, this is the dollar. It's coming down over here, right through here. This thing's going up. So again, as long as the dollar stays flat to sideways, or maybe even a little weaker, this looks good. Okay, what about RIO? Rio Tinto, it looks a little sloppy in here. You're trying to finding support right now at the 50-day moving average, but relative strength is actually bearish. It's gone below that 40 level. On a bull trend, you want to see this 14-day RSI stay above 40, and you're down here at 30 right now. So having a little problem with that. Short-term MACD is bearish. Also, this is my 30-day. 36 in here. Let me change it to 30. 30-day stochastic is also, is below 50. So the trend's kind of is lower in here. If it breaks this 50-day moving average, you're probably, you could come back down here and test that. Isn't that a Brazilian stock, if I'm not mistaken? Okay, that's our 30 minutes. Again, if you have some other questions, just send them in this week, and I'll answer it individually. As we're closing up here, we're getting the Dow's up about 65, Nasdaq's up 40. I'm not sure if Yellen's already speaking or whether she starts at 12:30. if she already spoke, she must have once again given the market what it wants to hear, which they were hoping she was going to back off of some of the statements that we got that some of the other Fed guys were coming out with last week. So in this case, again, if we're going to a sell on Friday, hopefully we'll get a little bit of a pullback, and you can look at some of those leveraged ETFs. That's going to wrap it up, and we'll see you next Friday. Or next Tuesday, I'm sorry.